Hello, and thank you for joining me to learn about the Technical Masters program. My name is Patrick Sresna, and I'm the Chief Derivative Market Strategist at Learn to Trade Global and the Chief Instructor of the Technical Masters program. Many of you are already lifetime Learn to Trade members and have been introduced to technical analysis in our weekend course or through our hands-on weeks and are asking the question, what is the Technical Masters program? I'm going to just take a quick few minutes of your time to do a review. A common question our members ask is the Technical Masters program complicated, and why should I take it? Well, a key observation is that there is much more to understanding the markets than the technical indicators giving buy or sell signals. There are essentially two widely accepted schools of analysis. Obviously, fundamental analysis, the most broadly used, and technical analysis. They have a very big difference in that fundamental analysis is the study of the quality of a company and the conditions of an industry, and often focused on the company internals like balance sheets and the dividend it pays and the products and services it offers. On the other hand, technical analysis is a study of price action and the study of the actual live auction of buying and selling in the process of the market determining the right price of a stock. And it is the study of the behavior of investors rather than the behavior of the fundamentals. See, technicals can't lie. If an analyst issues a buy recommendation but the stock is exhibiting characteristics of distribution, then technically one can ask the question, if it's such a great buying opportunity, why is the smart money selling on the news? You can't tell that by just understanding fundamentals. One has to observe the way the market is behaving. The Technical Masters program is, again, just not about the buy and sell signals, but rather the study of reading the chart and the way that everything is behaving. It is a week-long program that focuses on trying to help you grasp the core concepts of understanding where to find asymmetric risk-reward propositions and to understand the intermarket relationships between currencies, commodities, bonds, and stocks. On the first day, we focus on understanding market structure. And while it is a comprehensive day-long process, I want to just simply illustrate a very basic concept of the way markets are structured. And I'm going to use Apple shares to illustrate this. Now, this is a chart here of Apple in late last year, going from June, July, all the way out to November and December of 2013. And what we have here is a stock that started at $56. Obviously, this is now the after stock split adjusted chart. And Apple basically went from $56 to about $74 in what we can identify as an $18 advance. And after an $18 advance, it proceeded to have a correction, and this is what we call a secondary move or a consolidation. One can immediately be able to, using just basic math, recognize that it went from $74 down to about $65, which represents about a $9 pullback. Notice that the pullback on Apple was literally 50% of the advance, the prior $18 advance. This is a basic rule of symmetry. There's so much more to this when we're using Fibonacci's and other types of things that we cover, but this gives a perfect illustration of that concept. But more importantly, after that market bottom occurred, the subsequent rally from $65 up to $82+ was also roughly about an $18 advance. And notice that the second rally between September and December was roughly the same dollar duration as the rally from July to and August. This is not a coincidence. These rules of symmetry and Fibonacci measurements and analysis that we subsequently teach tries to help our students understand these natural relationships. After spending the first day on that market structure, on the second day we then go and immerse ourselves in understanding the important different techniques on how to enter a stock, how to manage the risk, how to exit on a loss, whether we're using stops or managing your way out of a trade, how to determine profit targets, and how to optimize the sale at a profit, and understanding the entire way of managing a trade through this entire process. Recognize that these techniques we teach actually actually are still done outside of the of indicators. We teach indicators later in the program, but this is solely based upon its price action and the natural market structure that we determine these entry and exit points. Next is day 3, and on day 3 we have the study of candlesticks and price action from the actual individual price moves themselves. We then go on to understand the core principles of intermarket analytics. It is in my opinion that intermarket analytics is the single largest influence in equity prices, yet the average retail investor has little to no clue of its working. Let me briefly touch upon what we call the macro intermarket story to help you grasp its importance. While many retail investors are drawn to Forex trading for its leverage and liquidity, many fail to grasp the importance on the currencies impacting everything from commodities to interest rates to stock prices. Currencies are the lifeblood of economies, and they represent 1/2 of every transaction in the world. As a country's currency is moving higher or lower, it has a direct impact on its trade balances, growth rates, and inflation. As those currencies are moving higher and lower, they have a very direct and material influence on the price of commodities, which is one of the core precipitating factors in driving inflationary and deflationary pressures. As those currencies and commodities are moving higher and lower, they have a direct influence on central bank policies around the world. The primary tool of central banks is to move short-term interest rates higher or lower to slow or to accelerate economic activity. Over the last few years, we have seen further intervention through what today is known as quantitative easing in order to manipulate interest rates in the middle to the long end of the yield curve. The movement of currencies, commodities, and the actions of those central banks are all key factors in driving the bond markets and ultimately what the interest rates within an economy are. One must recognize that the bond markets are substantially larger than the stock markets and have a much larger influence on the overall economic health of a country. In turn, interest rates are a key precipitating factor in the pricing of real estate. As interest rates move lower, it allows real estate to more naturally appreciate and to create the wealth effect within an economy. Inversely, any sustained rise in mortgage rates slows borrowing and the amount an investor is eligible to borrow, and ultimately can weaken real estate prices. Each one of these markets, the currency markets, commodity markets, bond markets, and the real estate markets, are all substantially larger than the stock market and have an immense influence on stock prices, valuations, and confidence levels. In order for one to be able to forecast the markets, one must be able to understand the macro intermarket story rather than the myopically focusing on the individual stock and its most current trend. On day 4, we cover market breadth and indicators. Many of you are already familiar with some of the most basic indicators, and in one part or another we simply are reviewing the application of our standard indicators with the methodologies we teach throughout the week. But in regards to market breadth, I wanted to illustrate one of the indicators we teach called the McClellan oscillator. We obviously have a more comprehensive group of them that we look at, but I felt this one chart we can go through and just to give you a clue of just how one would use some of these different things to understand the markets. In this chart, we go through 5 years of history, and I labeled the extreme overbought and oversold conditions by labeling or marking them in the red and green zones, red being overbought and sell signals, and green being oversold and buy signals. If one overlapped each one of these highs and low swings with in the colored zones with the actual stock market, you can literally identify the key market highs and lows in each of the market cycles and swings over the last 5 years. Using these types of oscillators, we can try to understand what the stock market is doing as a whole, rather than again focusing on one individual stock. And finally, on day 5, we have a live trading tutorial. During that day, we put everything we've learned in the last 4 days into application in the live markets. Not only do we focus on individual stocks on daily charts and weekly charts to kind of give investors a process or stock traders a process, but at the same time, we also accommodate those that are looking to day trade and use and focus these techniques we teach on more short-term active trading and the use of those market structure to profit from those shorter term moves. Those 5 days encompass the week-long program, but we have an additional 6th day to focus on the psychology of trading and risk management. That is an independent day in the following weeks. In order to be able to trade the markets, one must be able to overcome the natural fear and greed that comes with human nature, and to be able to assess each opportunity for the risk-reward proposition it offers. Stocks are always the cheapest when everyone is scared and has the least confidence to act, and subsequently stocks are always the most expensive when investors are the most confident and the most complacent. We focus our students on learning the art of independent thinking and to try to recognize things for what they are rather than what they want them to be. We know that many of our members are trading while working full-time jobs or are busy with their lives, and taking a week off to attend a program may not be timely. That's where we've put together a degree of flexibility on how our members can obtain the information. Throughout the week, you can either attend live at our office or watch it live online in the convenience of your home or anywhere you have internet. For those of you that cannot watch it live, we make the recordings of the session immediately available afterwards. And throughout the following month, and at your own convenience, one can review each session and get the benefit when it fits your schedule. If you have questions about the content we cover throughout that week, you can call or email me, and I'll be happy to take a few minutes to answer your questions. If you would like to reserve a seat to attend the upcoming Hands-On Week Masters program, please reserve your spot by responding to the email you received or calling our office. Thank you for taking the time to learn about the program, and I look forward to seeing you in the upcoming weeks or months.